Are you ready to unravel today's stock market nonsense? Fallout from the Fed's decision has stocks mixed today, the tariff standoffs continue, and gold hits a record high. That despite the latest economic indicators suggesting resilience in the U.S. economy despite those tariff headwinds. Now, don't click away. We'll get into all of that and more, plus check out how our strategic test funds are holding up this week and snag today's game changing tip to sidestep risks that could be impacting your investments. Tune in to stay ahead. Hey, since you'll forget at the end, just go ahead and like the video now. The market ended down slightly today with the S&P 500 down 0.22%. The Dow was essentially flat. The Nasdaq was down 0.33%, and the New York Stock Exchange was down 0.22%. Now, in terms of the top market events for the day, the Federal Reserve's rate decision aftermath. U.S. stocks showed mixed performance today following the Fed's decision yesterday to keep interest rates unchanged. The Fed signaled 2 potential rate cuts later in 2025, bolstering investor optimism earlier in the week. However, the Fed Chairman Powell today expressed cautious comments about economic uncertainty and tempered some of that enthusiasm. That led investors to reassess some of their growth expectations. Gold hits record highs. Gold prices surged to new peaks today, hovering around $3,000 an ounce. That was driven by safe haven demand amid market volatility and geopolitical tensions. This followed by the Fed's steady rate stance and ongoing uncertainty over tariffs, with commodities like gold benefiting as investors are seeking stability. Now, we'll see what happens with this audit of Fort Knox. What do you think is going to happen? Do you think that they're going to find gold there? And if not, be sure to comment down below, what do you think that gold price would rise up to? Economic data and sentiment. Investors digested the latest economic indicators, including retail sales and housing data, which suggested resilience in the U.S. economy despite tariff-related headwinds. However, sentiment soured this afternoon after Chairman Powell's remarks, and some analysts like Goldman Sachs are cutting GDP growth estimates down to 1.7% from 2.4% and raising their odds of a recession up to 20%. Overall, investors' unease over tariffs and economic growth, tempered by lingering hope from the Fed's outlook, kept Wall Street on edge today as it gets ready to close out a turbulent week. The portfolio ended lower today, about 1.25%, with our biggest losses being in MNSO Group, down about 4.5%, and Caesars Entertainment, down about 3%. Palantir and Tesla were the only positive returns for the day. And we'll see how things shake out next week, but for now, I'm not planning on making any more changes to the portfolio. And if you're new around here, I'm not a day trader. I coach long-term investment strategies that leverage statistics and math to help you build secure portfolios and mitigate risk. Now, speaking of statistics, let's take a look and see which ones are leading the pack this week. Now, it looks like Trainer's Measure is still on top today, although expected return did make a jump. It wouldn't surprise me if that was driven by gains made by midday prior to Powell's comments, with investors looking more into growth at that time. The standout stat for me this week are really the short-term returns on all these funds, because they all seem to be based on about 90 days or 1 year. Now, the numbers shown here are week to date, so our top funds have produced a 4.5% return so far this week. And you'll have to come back tomorrow to see how they finish up and if Trainer's Measure remains on top. Today, for our strategy recap, we're discussing Trainer's Measure. And Trainer's Measure, like Sharpe's Measure mentioned yesterday, is one of 2 metrics that we leverage that uses the risk-free rate in order to calculate a risk premium. Now, if you don't know, the risk premium is the expected return of the asset less the risk-free rate. So in theory, if the return on a 1-month treasury is guaranteed, and it's say 4%, then you should never accept a return from your investments that's less than that 4% return. In fact, if you're going to take on something else, you should be paid a premium. Now, when you calculate the risk premium for your investments, it should always be positive. If it's negative, you don't even want to consider the stock. You can earn a better return with assets that have literally no risk, so why bother? Now, I know some of you will continue to ignore the statistics and make that investment anyway, but just know that the math is against you, and if the math is against you, Wall Street will be too. Getting back to trainer's measure, because you're dividing the risk premium or the premium that you get for holding on to that stock by the stock's beta, or how much the stock moves with the index each day, what you end up with is referred to as the reward to variability ratio, which is just a fancy way of saying how much return you're getting for each movement in the market. Now, knowing that, hopefully now you understand why investors like to reference this metric during times of volatility. Our testing does show that it can work well in times of volatility and growth, but it also experiences the most variations between all of our test funds. So if you're looking for a long-term safe haven, this isn't your metric. Now that said, it can be very lucrative when leveraged at the right time. For last week, Trainer's Measure had mixed returns, and it was actually the only metric that had test funds go negative, and it had the lowest average return out of all of our metrics last week. In terms of the quantity of assets for the portfolio, 8 performed the best, and from a return history standpoint, 3 years actually produced the best returns. Now, if you're looking for the best performing trainers-based portfolio last week, it was the portfolio with 5 assets and 3 years of history. Now, in general, Trainer's metric is an interesting one to use for stock selection. It does perform better than a lot of the other metrics that we tested, and if the timing is right, like I said, it can be very lucrative. But it's difficult to time, and out of all of the statistics, it's the one that returns losses the most frequently. So I use it as a point of reference, but typically not as a standalone strategy. Today's tip is all about portfolio optimization, and once you've selected the assets that you want, say you're leveraging our asset and portfolio grades, and now you have a portfolio that you're comfortable moving forward with. How do you know how much to invest in each stock? That's where the concept of portfolio optimization comes in. If I can attempt to simplify the concept, I would put it this way. Essentially, a computer produces a random weight set for your assets. Our site will do that 10,000 times, and then it goes back in time to see which one produced the highest return while taking on the lowest amount of risk. From a technical standpoint, it's the portfolio with the highest slope on the capital allocation line, but if you're looking for that level of knowledge, go check out our full training program. For today, what you need to take away from this is that a computer can use statistics to find the combination of weights that would have worked out best historically. Then an optimizer is going to show you those weights. Most traditional investors will move to those asset weights because it's been proven to be the best combination over time. Now, while that can change over time, that's why you come back and you rebalance. That will ensure that you're positioned to produce the best possible return over the long term. And by rebalancing and maintaining optimal portfolios, what you'll find is that your portfolio will act a lot like your own personal index fund, combining the assets you want while producing a market-based return, just like a pro. Well, that's it for today's episode. As always, I appreciate you being here. Until next time, I'm Matt Franklin. I'll see you back here tomorrow. Hey, just a friendly reminder to do something below the video.